CMCT missed Q2 2026 consensus EPS estimates today. I mean, they reported a loss of $4.03 per share, missing the mark by 92 cents.
Yeah, that is a pretty massive miss right out of the gate.
Right. But then on the top line, they actually beat expectations. They brought in $29.68 million against an estimated like $28.1 million.
Which is interesting, considering that bottom line miss.
Exactly. And looking ahead, management's guidance is focused heavily on improving FFOs, so funds from operations in 2026 and 2027. They're evaluating potential asset sales and looking to capture a $16 million run rate lift from preferred stock redemptions.
But despite that revenue beat, the stock still dropped, right?
Yeah, it dropped 4.62% to 4.8555 post earnings.
I mean, that market reaction really tells you everything you need to know. Investors are just heavily discounting that top-line beat. Instead, they are, laser-focused on CMCT's structural liquidity constraints.
So for you listening to this deep dive, our goal here is to figure out why a revenue beat triggered a sell-off. And to do that, we need to look at the segment performance. It's kind of like a three-legged stool, right?
Right, where two legs are solid oak, but the third is, severely termite damaged.
Exactly. So let's look at the solid oak legs first.
Yeah.
The multifamily and hotel segments.
Yeah, those two holds are definitely pulling their weight. I mean, looking at the multifamily surge, net operating income jumped 238% year over year. That's up to $638,000.
Oh, wow. 238%. That's a huge jump.
It is. And same-store occupancy hit 95.3%, which is really being driven by the strong, sustained rebound in the Bay Area market.
And the hotel segment is shining right alongside it, honestly. Hotel NOI grew 11% to $4.6 million.
Yeah, and they're running at an 80.7% occupancy rate, right?
Right, with a RevPAR of $180.47. And that's really a direct payoff from those extensive renovations they just finished at the Sheraton Grand Sacramento.
Okay, but then we get to the termite damaged leg of the stool, the office sector.
Yeah, that's the real drag here.
Office NOI fell down to $4.0 million from $5.5 million year over year, which is a pretty significant drop.
But this is where the numbers get a bit tricky, because consolidated NOI, if you exclude joint venture losses, actually rose 22% to $12.5 million.
Yeah, so their wholly owned core assets are actually doing just fine.
So what exactly is pulling the office segment down so heavily if consolidated NOI is actually up?
Well, it's really driven by two things. You have these massive non-cash fair value adjustments, and then you have severe joint venture losses.
Meaning the on-paper value of the buildings tanked.
Exactly. But the joint venture losses are the real cash drain. The office properties they co-own with partners are bleeding cash, and that basically offsets the 22% gain from their wholly owned stuff.
Okay, but wait. If their consolidated operating income is actually up 22%, why did management have to execute that cumulative 1-for-100 reverse stock split earlier this year?
That is the million-dollar question right there.
Right, because you don't execute a 1-for-100 split if your balance sheet is healthy.
No, you absolutely don't. And it points straight to their structural balance sheet strain. The glaring risk here, the big one, is this $97.1 million non-recourse mortgage on their Oakland office building.
And that just matured, right, in Q3 2026.
Yes, it matured. And management explicitly stated that they elected not to invest any additional capital to refinance it. Instead, they are actively negotiating with the special servicer.
Wait, so they're basically just handing the keys back rather than pay to refinance?
Pretty much. Because it's a non-recourse loan, the lender can only take the collateral, which is the Oakland building itself. They can't legally touch the profitable apartments or the hotels to cover that debt.
Okay, so they're just cutting off the termite-damaged leg to save the rest of the stool.
Exactly. They are amputating a toxic asset to protect what's left of the balance sheet. But it really shows how aggressively they're trying to preserve liquidity right now.
Which leaves you, the investor, with a really fascinating tension to think about tonight.
Right. Because CMCT is sitting on this 12% rent-to-market gap in their highly desirable Bay Area apartments. So there's all this built-in future revenue growth just waiting to be unlocked.
But at the exact same time, they're literally walking away from a $97 million toxic office mortgage because they don't have the cash to save it.
Yeah. So the question you have to ask yourself is, are you buying a deeply discounted real estate recovery with massive apartment upside, or are you just catching a falling structural knife?
It's a tough call. But that's all we have time for today. Be sure to follow the show for your daily earnings coverage, and we'll catch you on the next deep dive.